All right, here's an example. We love these examples. Gotta love them. Let's see what we're dealing with here. Well, Worthy Inc. purchases 70% of Bingham Inc. for 70 million in cash. Awesome. Well, the fair value of Bingham Inc. Now, it might give this to you, it might not. This is what I've shown you before. How do you determine what the total fair value of Bingham Inc. is? Like a lot of this might not be given to you, so you might have to do it yourself. I gave it to you. Why not? Right. So how do we determine the portion that's NCI? Well, if it's nice even numbers, 70 million for 70%, well, that means 100 million is the total value. You only own 70, so 30 is what you don't own. That's the NCI. NCI is 30 million. Cool. Gonna pause there. Just look through that again if that doesn't make sense, but that's pretty nice numbers, right? 100 million is the total value. So NCI is 30. Now, also given is the fair value of Bingham Inc., which includes goodwill, the fair value of Bingham Inc.'s identifiable assets, and the book value of Bingham Inc. net assets. Now, what do we take from this? We can see that we have 10 million of goodwill because the assets without goodwill is 90. The assets with goodwill is 100. So, okay, right away, we know we have 10 million of goodwill. And then what else do we have? Well, the fair value of the identified assets without goodwill is 90. Book value is 65. We know now that we have a $25 million fair value adjustment. And again, in a perfect world, sure, we would constantly update our book value to match our fair value, but that's a lot of work. That's a crazy amount of work to constantly update your book values of your assets, right? So we're going to do it maybe once a year, maybe every couple of years, but especially when we're dealing with an acquisition. It's a great time to do it. So what's our consolidated work paper eliminating journal entry at the acquisition date? And now we're going to refer back to that graph, that design I was telling you about before. And here it is. Well, these are all the accounts in the same places in that diagram, right? So NCI is 30 million, investment in subsidiary is 70 million here, right? That's pretty straightforward. This is the total value, 100 million. So these are both going to equal $100,000, right? Both sides. We've got the total value of 100 million. And let's break that down in terms of what we're dealing with. Well, book value is 65. Fair value adjustment is 25. Goodwill is 10. That gets you to 100 million. Now, a question could ask you any of these. It could say, oh, what's your balance sheet fair value adjustment? What's goodwill? What's the NCI? So it's just important to be able to calculate all of these and find these out. This template, this format, I think it's great. It's wonderful. Take a look at it. Become familiar with it. It'll really help you. And here is that broken out again, well, with journal entries. The same numbers, same everything, same accounts, but with our journal entries now. So you see, we're not going to have every single journal entry filled out. We don't have identifiable intangible asset to fair value. We don't have to write that up. There's nothing there. That would just be another adjustment. Common stock, subsidiary, all of this, it's included in that amount that's eliminated, right? This is the subsidiary's eliminated amount right here. Investment subsidiary and NCI, that equals the total value of the company. So this right here, again, this is basically the journal entry, right? These are both sides. These are the debits, these are the credits. Here are debits, 100 million, credits, 100 million. And here it is broken out by all of the moving parts. And if this makes sense at this point and you're doing well, then I'd say you're doing well on the consolidation part. I'd say really the next and, kind of more difficult, not more difficult, but other difficult part in this section is the eliminating journal entries. And that's other items, right? Intercompany transactions between subsidiaries. If there's not if I'm selling to my subsidiary, I basically have to eliminate those transactions because they're not real. They're not real. It's basically like I'm transferring them within myself. That's not a real sale if I'm selling to myself. That's really the only last tricky, difficult part with our consolidations, business combinations. But I just want to take a pause and say, if you're doing well so far, then I'm happy for you. You're doing well, and you should pat yourself on the back. It's a lot. It's definitely a lot. You're sticking with it. You're staying strong, and you are gonna overcome this test.